everybody. Welcome back for another episode of Markets and Economy. It seems like it's a show, but it's actually educational, but you'll be so entertained. You won't even know it's educational. Thanks, everybody, for giving us some of your valuable time as we talk through what's happening right now with markets and economy and investments and all that stuff. Before we get into the goodies, we always have to do our disclosures here. So, this is a produced episode by Destiny Capital. We're doing our very best to make sure that everything is accurate and up to date. It's possible that we made errors somewhere in here in the conversation. We'll do our very best not to do that. But we recommend, if you already work with us, reach out to your team before you make any decisions. If you don't work with us, reach out to your professionals, your CPA, tax advisor, attorney, other advisor. Make sure that you're getting good counsel before you try and take anything from this and apply it to your own personal life. We're going to talk about a few different securities in the context of the conversation today. We and our clients may or may not maintain positions in those securities. They are very, very large, so we are in no way able to move the price of said securities, but we may have some positions there. And then we're a registered investment advisor regulated by Securities and Exchange. So let me go back and allow us to do the intros. I'm Jarrod Musick. I'm the CEO here at Destiny Capital, and I'm a member of the investment committee and thought partner for Tim Doyle.
Yeah, thanks, Jarrod. Yeah, as Jarrod mentioned, I am actually the manager of the investment committee here at Destiny Capital as the chief investment officer. And on the investment committee, that's where we conduct capital market research, fund due diligence, investment manager selection, portfolio construction, trading, rebalancing, and all that. And then we also put together these webinars for our clients and blog content that we send out on a monthly basis. But we've got a lot of interesting stuff to cover this month, so I'm excited to kind of get into that.
Yeah, me too. All right. So we're sitting here in late September. The Federal Reserve finally did a rate cut that was kind of long talked about and discussed in terms of how big and when and all of those things. So can you walk us through what's happened recently with interest rate policy and then, what the role of the Fed is and some of the stuff that they're looking at as a part of this decision?
Yeah, absolutely. Yep. Investors got the long-awaited rate cut that they've been hoping for quite some time now. The last rate cut that we got was in December of 2024. You can see that in the chart to the top right, where we've got essentially the Fed funds rate over time. And you can see towards the right side of that chart, rates remained unchanged for quite some time, to the dismay of politicians and some investors and economists. But this month, on the 17th of September, we did get that rate cut. And investors were largely expecting that. So that's no surprise. I think what we were hoping to find out was the future path for interest rates. And we got a little bit more information on that, which we'll get to in a second. But when it comes to the why behind the rate cut, Chairman Jerome Powell, cited weakness in the labor market as the primary driver of this decision to cut rates. Jarrod and I have talked over previous months about concerns in the labor market. Jobs numbers have been extraordinarily weak since about May of this year. We've seen revisions in the BLS jobs reports that continuously revise down the number of jobs created in the US economy month after month after month. And that really opened the eyes for many investors because the labor market had really been a source of strength for the US economy for quite some time, to the surprise of many. And we're finally starting to see some cracks in that, to the point where the Fed felt like it needed to make this decision to cut rates in order to boost the economy and in turn, hopefully boost the labor market a bit. But it's important to remind everybody that the Fed has a dual mandate. Their dual mandate includes keeping inflation in check, so that's stable prices, and keeping the labor market at full employment, roughly 4% unemployment rate. But as we all know, we're seeing inflation tick up in recent months, and the labor market is breaking down, and we're seeing the unemployment rate rise a little bit as well. I believe it's at 4.3% currently. So these two dual mandates are in conflict, because if the Fed cuts rates and continues to cut rates, that could boost the economy, and in turn boost liquidity, which could also start to cause inflation to tick up. So that's a little bit concerning. So that's something we're gonna have to keep an eye on. Do these rate cuts, these projected rate cuts, spur inflation even higher, or is this kind of a one-time thing? And when the Fed was justifying this decision, they felt that the uptick in inflation was largely due to a one-time impact related to tariffs. They believe that was a one-time impact on inflation, and that's going to dwindle over time. That really remains to be seen. I think we heard that same story in 2021 when the Fed kept saying that inflation is transitory. This is just a one-time thing as the economy comes out of the COVID-19 pandemic, as the economy gets up and running again. That turned out not to be the case, and inflation was very, very sticky and remained high for a very long time, went up to 9%. We all know that story. So it's a little concerning that they think that they don't take this inflation story as seriously, perhaps, as they should, because they are projecting 2 additional rate cuts between now and year end. So it's a bit of a dichotomy, and this is something we're going to have to watch closely as data comes in related to the labor market, inflation, and so forth. But largely, investors had been pricing in 3 rate cuts in 2025. So the Fed's projections are largely in line with what investors were expecting. So there's no deviation there. So investors got what they expected. So we didn't see any volatility necessarily related to this decision. So that was a good thing for investors and financial markets. But moving forward, when we're thinking about the labor market, one thing we'll touch on the next slide is the impact of AI as a disruptive technology and how that could potentially impact the labor market. As it stands now, Chairman Powell spoke about this briefly, and he said the Fed does not believe that AI is seriously impacting the U.S. labor market at this time. But like I said, that dynamic could change in the future, in the quarters ahead, or the years ahead. So we'll touch on that on the next slide. But Jarrod, that was a lot to unpack there. Anything else you would like to touch on or highlight?
Yeah, I think we talk about the Fed quite a bit because their role in setting monetary policy is pretty big for the U.S. economy and the global economy. So, just as a reminder, if you can picture, that statue, Lady Justice, right, with the scales where they're balanced, that's really what the Fed is trying to do here: is get those scales in balance where is availability of capital cheap enough where businesses want to borrow, they want to hire, they want to start projects, all of those different things, but not so cheap that we end up really accelerating economic activity and generating inflation. On the other side of that scale is employment, right? They want people to be employed, they want them to have jobs. But if too many people are employed, too many people have jobs, we have a labor shortage, that spurs inflation, right? On the other hand, if you keep monetary policy too restrictive, people end up unemployed because businesses aren't hiring, they're downsizing, there are fewer customers buying, et cetera, et cetera. So it's a very, very large, complex system with lots of different elements that influence it. And so the job of the Fed is not easy at all. They have to try and interpret this data, peer into what they think the future is going to look like, and make good decisions. So I think this had been expected for quite a while that we were going to get an interest rate cut here. We're higher than kind of the normal standard interest rate set just for a normal economy. But they really don't want to kick up inflation, and you can see in the red square down there, running around 3% inflation in terms of expectations. So that's definitely the concern: is how big is that going to be? So I think that just summarized everything that you said, Tim. But
No, that was great. Yeah, these decisions are not easy, and they are very impactful on the economy as a whole. So that's why we like to spend a little bit of time covering that almost in each webinar that we're conducting, in each letter that I write for investors. So
yeah,
good stuff.
The other topic du jour, AI. You can't seem to get away from anything AI related. If you go in and do a Google search now, the default, I don't know if anybody's noticed, but the default has swapped over to the AI version. I think it's Gemini, is Google's AI engine that's trying to help keep Google searches relevant. If you hop in a Tesla and drive somewhere on full self-driving, or you're in a restaurant and you hear somebody talking about a conversation they had with ChatGPT, it is literally everywhere for all of us right now. So we're all well aware. But I think looking at the underlying economics of it, Tim, can you kind of walk us through, these hyperscalers, these very, very, very large companies that are building out the data centers that are powering AI, sort of what's going on there, and then what does AI adoption look like across the workforce right now?
Yeah, I want to touch on first on build outs and then a little bit into adoption. And these two charts on this page speak to both of those points. So in the chart to the left, this shows the CapEx, capital expenditures from the major AI hyperscalers. So the companies that are investing the most in AI, Alphabet, Amazon, Meta, Microsoft, and so forth. And I want you to focus on the left side of that chart, or on the left chart, the gray bars, because that shows the amount in billions of capital expenditures that is essentially being invested into AI. And you could see that chart essentially hockey sticking up. And the kind of lighter gray bars show forecasts for expenditures in 26, 27, and I believe that will probably continue to grow higher in 2027 and beyond. So the investment in this, the commitment is extraordinary, and the investment is just mind-boggling with the numbers that we're looking at. We better see adoption of AI technology, and this technology better work. There's a lot of pressure on these companies to have a proof of concept here to show that AI can really be a powerful tool and as disruptive as they're claiming it can be. That remains to be seen, but we are seeing adoption, and we see that in the chart to the right. And this chart shows businesses across different sectors that are using AI currently to produce goods and services, and how that's changed over time and how that is expected to change in the next 6 months. So we could probably focus on the information technology sector, the top bar there, which shows just the growth. So the light blue bar shows adoption in 2023, the percentage of companies that were using AI to produce goods and services. That was roughly, let's call it 15%. And then in 2025, that's jumped to 26%. And then if you look forward over the next 6 months, we're not talking years, we're just talking a couple months here, we're expected to see that percentage of companies rise to over 35%. And you see that same story play out across sectors. So professional and technical services, finance and insurance, educational services, and on down the line. So, when we talk about disruption, AI is, at least now, projected to be an extreme disruptor for these sectors, particularly the information technology sector and coding and so forth. Jarrod, you and I kind of talked about that offline, but it's going to touch many sectors over time. And my concern is, how does that impact the labor market over time? Is AI disruptive to jobs? Is AI going to take over human capacity in some of these jobs and some of these sectors, driving unemployment higher? That's not something that the Fed has had to deal with previously, right? That's not something that they've had on their docket to review as it relates to a driver of unemployment and so forth, and jobs gained or lost over time. In fact, typically when you want to impact employment and spur job growth, you lower interest rates. Well, if interest rates are lower, that potentially means that companies can invest more in AI, which would exacerbate this problem a little bit more over time, as they continue to dump money into that, because we'll have cheaper money. They can borrow money for cheaper with lower interest rates. So anyway, we don't need to go down that rabbit hole. It's just something I found extraordinarily interesting, because we are hearing a lot about AI, and just seeing the chart to the left and the capital commitments we're seeing into the growth of AI and the development there is mind-boggling. And then the adoption has been fast and furious and is expected to be continue to be so. And we see that in the chart to the right. So, Jarrod, anything you wanted to add onto that?
Yeah, I think there's certain certainly industries where AI adoption is going to be slower just because it fitting into what those businesses do and what the people in those businesses do is more difficult, right? So you think about construction. AI is not going to go frame a house or install the roof, right? Or run the wiring. But can AI help with scheduling and product ordering and routing of drivers and things like that? Absolutely. So, I think some of these very large industries that have low adoption right now, as there are better and better use cases, you're going to see that accelerate. And so when we look at this total across all industries adoption, to go from currently about 10% of companies overall are using AI to help produce goods and services, just in the next 6 months, that's going to jump by about 50%. So it's coming quickly, and I think none of us know exactly how this is going to work out. Is this another, internet moment? Is this another, distributed cloud moment? Is this one of those where it will destroy a bunch of jobs but create an equal or greater amount to be able to utilize this new tool set? Or truly does AI start to take over certain industries from a thinking, leading, doing perspective? We don't know. But we do know that companies are betting on a lot more people using it, and they're spending a lot of money on those data centers to be able to provide the compute time and the compute power to make this all run. So it's something that we're certainly watching. It's going to be fascinating to continue to monitor this over the next couple of years.
Yep. Yeah, it was interesting. The Wall Street Journal produced an article a few months ago called "The Great Hesitation," and it spoke towards the hesitation of HR departments across the information technology sector on hiring, because if innovation is coming fast and furious, they're pressing pause on hiring certain employees, waiting to see if the technology catches up and that technology can potentially replace those new hires that they were looking to onboard. So we don't need to get into that, but I just thought it was interesting. The Great Hesitation, spoke towards what's happening potentially in the labor market, and how job growth has been so minimal, as
Mhm.
potentially HR departments across the country are taking a wait and see approach to see if this new technology emerges in the next 6 months that could potentially fill roles in their organization. So
Yep.
interesting times for sure.
Yeah, absolutely fascinating. So at the end of the day, what we care a lot about is how our investments performing. So can you walk us through what's happened for asset types, broad asset class returns so far this year, and what we're looking at in terms of cash and lower yielding
Yeah,
investments right now?
that'll be really interesting. Yeah, we'll start with just year-to-date returns of two very broad asset classes: stocks and bonds. When we talk about stocks, we tend to talk about the S&P 500 as a whole, and when we talk about bonds, we talk about the U.S. Aggregate Bond Index. And the chart to the right shows the performance of each of these asset classes on a year-to-date basis. Most of this data, I believe, this chart is as of 9/24, so pretty close to this production date. And we see it's been a very good year for both stocks and bonds. We see the S&P 500 up over 13% on a year-to-date basis. We had a scary time there in April where markets sold off. That's just another lesson for investors not to try to time the markets and exit at the bottom, because we've seen from there an extraordinary rise on back up, and it's been quite a ride for investors in stocks. But moreover, in bonds have struggled mightily since about 2022, and it's been tough sledding really for about 5 years for bond markets. This has been really the first year where we've seen bonds move steadily higher and provide that portfolio ballast that we really look for in our fixed income allocations. You could see where between March and May of 2025, where stocks sold off, you see that in the blue line. In the orange line, you see bonds really holding steady and providing that portfolio ballast, keeping overall portfolios from dipping too low, and so forth. And that was really great to see. But I think the story here is that stocks and bonds, both really, the stock market and bond markets really like stimulus. And we've seen stimulus implemented thus far in 2025. So A few months ago, we had the, what do you call it, Jarrod? The O-Trip-B tax bill, one big beautiful
Yes.
tax bill, the O-Trip-B tax bill,
Good
which is
trip BA. I'm trying to get it to stick.
okay, yeah, yeah, I like it. So, so we saw that tax bill, which is fiscal stimulus. So we're getting lower tax rates for folks, and tax cuts for some mean, more disposable income that people, consumers, can spend in the economy, and theoretically spur growth. And then we also had the first 25 basis point rate cut, and the stock market likes rate cuts as well. And the stock market is betting on 2 additional rate cuts, and that's what the Fed is projecting. So interest rates are moving lower. Stock markets like that, and bond markets like that, just as much, if not more, because there's an inverse relationship between rates and bond prices. So as interest rates fall, bond prices move higher, and we've seen that take place in throughout 2025 as the expectation of rate cuts has come, and as we've seen them materialize, bonds are doing very well and could do well, in the near future. So yeah, it's been a very, very solid year. I don't know that many investors were expecting, at least at this stage of the year, a 13% return for the stock market, particularly on the heels of 2 very good years in 2023 and 2024. And it's very reassuring to see bonds once again doing what they're supposed to do in client portfolios, which is provide ballast, provide income in the form of yield through bond coupon payments and so forth. So a positive story for stocks and bonds overall. But it's important to keep in mind that some of this is stimulus driven, and stimulus can cause a little bit of a sugar high in markets, and we'll get into valuations on the next slide. So that's just something I want to touch on as well, is how stimulus can boost markets, and how long can that boost really last. So something to be mindful of. And one final thing on this page I wanted to touch on was the rates for cash equivalents. So as the Fed cuts interest rates below 4% and closer to 3.5% by year end, that's going to impact cash equivalent investment vehicles like money market, CDs, savings rates, and so forth. So as the Fed cuts the Fed funds rate down to, like I said, those rates closer to 3.5, we would expect to see CD rates fall below 3.5. We would expect money market funds to be paying below 3.5. And it's really fascinating to note that we have in the US a record amount of investment in money market funds, roughly $7.3 trillion invested in money market funds. But it's something to keep an eye on, because as those rates become less attractive, and as inflation remains high, your real return is potentially very low to flat, if not negative, if rates continue to move lower. So something to keep an eye on. If you have cash on the sidelines, or if you have a CD maturing, you're not going to be able to reinvest that CD at a high rate of 4% or plus, 4% or higher. Investors over the last few years in money market funds have enjoyed 5% rates, 4% rates, really strong rates on those money market funds, those safe money market investments. But those days are coming to an end if the Fed does continue to cut interest rates. So that's just something to keep in mind. If investors do have money on the sidelines, you're going to need investments that can exceed the rate of inflation. And that usually means stock market investing. So you don't erode your purchasing power over time by keeping too much in cash. And to a lesser extent, bonds could potentially exceed inflation as well. So I wanted to touch on that because I think that's important, because given the record amount in money market funds, we're going to have a lot of investors coming to that realization in a very short period of time. And who knows, that could provide tailwinds for the stock market as some of those money market investments cycle into the stock market and or bond market. So Jarrod, anything you wanted to add? I know that was a lot there as well.
No, I think that's, we're getting some of the benefit of interest rate cuts, but it does mean that we're going to need to do some reorganization, all of us, on personal cash and cash holdings and cash reserves and things like that. So that's definitely something that we work with on our clients to make sure that, hey, money that I need here in the next 30 to 60 days is liquid and available. Anything beyond that, we really want to be generating some type of return and some type of yield. So how you layer those together is going to be something that we'll tweak here in the next year or so for most of our client families. So definitely something to pay attention to. Um, on the other side, from yield and cash, looking at equity returns and just valuations inside the US stock market. Can you walk us through where we're at currently and what's driving overall valuations and valuations for the top few companies?
Yep. Yeah. When we talked about on the previous slide, rate cuts and a potential sugar high in the stock market, we kind of see that in valuations as we're looking at an index like the S&P 500, which is our reference for the quote unquote market. Um, when we look at valuations, we look at the PE ratio. I'm not going to really get into the PE ratio, how it's calculated, what it means, but just essentially when the PE ratio of the stock market of the S&P 500 rises above the 30-year average, um, that means it's tending to get a little expensive. And we're seeing that if you look to the chart to the right, that shows the PE ratio, the forward PE ratio of the S&P 500 over time. And it shows today, or at least as of September 24th, 2025, the PE ratio, the forward PE ratio of the S&P 500 is close to 23. The 30-year average PE ratio for the S&P 500 is 17. So I think it's pretty apparent when you look at this type of chart, when PE ratios exceed, let's call it 22, you see that back in the 2000s, you see that in 2021, and you see that now. Historically, we've seen what we would call a reversion back to the mean. So when we have a mean reversion for the stock market, that typically means that the market sells off a bit, we see some volatility, valuations come back down to earth a little bit, and then the market moves on as usual. So when I look at this chart, I would think, well, yes, the stock market is quite expensive at this time, but you have to have some perspective on these valuations. And I wanted to touch on that because a lot of the market valuations are being driven, the high valuations, I should note, are being driven by a select number of mega cap tech stocks, these AI hyperscalers that we talked about on the previous slide, the NVIDIAs, the Metas, Microsoft, Amazon, Tesla, Alphabet, Broadcom, Oracle even these days, and Apple. So you look at NVIDIA, it's got a PE ratio of 50. Tesla is at 253. So when you lump all of these mega cap companies together, they are actually tipping the scales a little bit higher and pulling the PE ratio of the overall market higher because they are so large and so impactful on the market as a whole. So when you look at the rest of the other 490, give or take, stocks in the S&P 500, those have a PE ratio closer to 20, and that's much closer to that 30-year average. So that's a little bit less alarming and less concerning than what really I'm seeing. We have 490 companies that have what I would call maybe a slightly elevated, but still somewhat healthy valuation level, whereas among a very select group of about 10 stocks is getting a little bit rich. And what that means moving forward is that there's a lot of pressure on these tech stocks, these AI hyperscalers, to really deliver on revenue and earnings. If we see these companies start to disappoint, either not meet or come below earnings expectations, you could see a harsh reaction from investors that would cause a potential sell-off. That's why, when you look at financial news media, all eyes are on the NVIDIAs of the world, the Metas of the world, the Microsofts, the Amazons, the Apples. That's why they're such a topic of conversation, because over the last year, they have been driving returns for the overall market much higher, and they are also in turn pushing valuations higher, which puts more pressure on those companies to perform. And if they are not performing, or if they come below expectations, there's potential for some volatility there. So just something I thought was worth mentioning. Yes, valuations, as we say, market is getting a little bit frothy. There could be a little bit of a sugar high we're seeing right now. But if these companies continue to deliver, I should note that these companies have, on an ongoing basis, met and exceeded earnings expectations over time. That could really justify these valuations. So that really remains to be seen if that growth really the estimated growth is supported by actual growth, then hey, these valuations could be perfectly justified, and we could see the markets continue to move higher. But there's a lot of pressure there to perform, and that's something we want to keep an eye on and not take our eye off. Jarrod, anything else you wanted to add?
I think it's just a good discussion to know that, market returns have been really good for a period of a couple of years in a row now. And that's always a time where we could see volatility. So when we look at asset allocation, that's why we hold for all clients a mix of, cash and cash equivalents, some fixed income in a lot of cases, private credit, gold, Bitcoin, other alternative assets, because you don't want everything performing exactly the same way all the time. So that's part of a portfolio design that we really work hard on our end. But equity returns are going to drive a lot of long-term investment performance, and it's just good to know where we stand at any given point in time. So great
Yep.
discussion there, Tim. Thank you.
Yep. Good point.
Well, as we kind of wrap up our session for the day, please, if you would, head over to destinycapital.com. You can throw questions in the CIO mailbag so that we can hit them in future episodes. You could always pose a private question that you wouldn't want us to hit on the episode, and Tim or I will respond to you. But we're always here to try and, create really good informational content that meets to you where your needs are. So please let us know how we can continue to do that job and do it even better in the future. Tim, any other things to be able to close us out for the day?
No, I just want to reiterate that we really appreciate everybody's time. If there's anything else we could be talking about of value for you, please don't hesitate to let us know. We're always looking to improve this content and what we're delivering, and we're welcoming feedback, like you said. And I'm always open for questions in the CIO mailbag. I love when questions come through, and like you said, you'll hear from us directly. But yeah, thank you for your time. We always enjoy this. So we'll see you again next time.
All right. See everybody again soon. Thanks.
Take care.